In the high-stakes arena of global precious metals trading, where gold and silver prices swing on the faintest shifts in currency values and borrowing costs, a development of profound significance has emerged that demands the closest attention from every investor and market observer. The United States government now finds itself paying more to borrow money than it has in decades, a reality that ripples directly into the demand for physical gold and silver as classic stores of value during periods of fiscal strain. To grasp the forces at work, one must examine an unusual currency operation the United States has not attempted since the late 1990s, an episode that began with a simple handwritten note observed during an official gathering and quickly escalated into coordinated market action with far-reaching consequences for interest rates, exchange rates, and the precious metals complex. The note in question outlined a clear directive to acquire Japanese currency in a substantial size ranging from $5 to $10 billion equivalent. Shortly afterward, questions arose about the motivation for this intervention. Official explanations framed the step as an expression of strong bilateral ties and mutual support amid a weakening Japanese currency. Yet the decision carried deeper implications for American borrowing costs, Japanese reserve management, and the broader landscape of global liquidity that ultimately influences gold and silver valuations. Currency interventions of this nature rarely surface in ordinary market commentary, yet when the United States Treasury steps into foreign exchange markets after nearly 3 decades of deliberate restraint, the reasons warrant careful scrutiny, especially for those who track how shifts in the dollar-yen pair affect the relative attractiveness of monetary metals. For several years, the Japanese currency had been sliding toward multi-decade lows against the dollar. The primary driver was a wide differential in interest rates. American authorities raised policy rates substantially during the recent inflationary episode, settling them near 3.75%. Japanese authorities, by contrast, maintained near zero rates for an extended period and only recently edged them higher to the 1% level. Such a gap creates fertile ground for the classic carry trade. Market participants borrow in the low-yielding currency, convert the proceeds into higher-yielding assets denominated in dollars or other currencies, and pocket the interest differential. In theory, exchange rate movements should offset the yield advantage over time, eliminating any free lunch. In practice, the Japanese currency continued to depreciate for years, allowing the trade to generate consistent returns and attracting ever larger volumes of capital. Estimates place the global scale of this yen-funded carry activity above $4 trillion, a figure that exceeds the entire economic output of several major nations. Because so many positions ultimately rest on cheap Japanese funding, a great deal of apparent risk-taking in equity markets, emerging market bonds, and other asset classes carries an embedded short exposure to the yen. When the trade eventually unwinds, the Japanese currency can strengthen abruptly, forcing simultaneous liquidations across multiple markets. For Japanese exporters, a weaker currency has offered competitive advantages, yet for ordinary households, the same depreciation has raised the cost of imported energy and raw materials, squeezing living standards and contributing to domestic inflation pressures. One imaginative measure of the currency's undervaluation compared the price of a popular Japanese pork cutlet curry dish across borders. On that informal basis, the yen appeared undervalued by roughly 60% relative to the dollar. More conventional purchasing power metrics reached similar conclusions, although they differed on the precise degree of misalignment. The point remains that the exchange rate had moved far from levels consistent with relative price levels and interest differentials, creating conditions ripe for either gradual mean reversion or sudden policy intervention under ordinary circumstances. American policymakers have long maintained that exchange rates should be determined by market forces rather than official intervention. Official reports regularly monitor trading partners for practices that might involve currency manipulation, and Japan has appeared on such lists. The decision to support the Japanese currency, therefore, represented a notable departure from established doctrine. The operation itself employed euros rather than dollars, drawing on holdings within the Exchange Stabilization Fund that included European government securities. This approach surprised counterparts in Europe, who viewed the use of their currency without prior consultation as a significant breach of customary protocol. International guidelines on foreign exchange intervention generally discourage operations in third-party currencies precisely to avoid such complications. The underlying motivation extended beyond bilateral goodwill. Japan remains the largest foreign holder of United States government securities, with holdings exceeding $1 trillion. Any substantial Japanese intervention to support its own currency would likely require sales of those securities to raise the necessary dollars. Large-scale sales would pressure Treasury prices lower and push yields higher. Higher long-term yields would increase American mortgage rates, corporate borrowing costs, and the overall expense of servicing the national debt. For a Treasury that has relied heavily on short-term bill issuance rather than locking in longer-term rates, rising yields pose a particular challenge. The preference for short-term funding rests on the expectation that longer-term rates will eventually decline, allowing the government to refinance on more favorable terms later. That expectation itself embeds a significant directional view about the path of inflation, growth, and investor confidence. Historical precedent shows that near zero interest rates in the United States have occurred only during periods of severe economic stress. Betting on their return, therefore, carries the implicit assumption of renewed economic difficulty. Meanwhile, persistent above-target inflation, elevated debt-to-output ratios, and ongoing fiscal deficits all argue for higher rather than lower-term premia. The market has already begun to reflect these realities. Recent auctions of 10-year and 30-year securities cleared at the highest yields in many years, marking the most expensive long-term borrowing costs since the early 2000s and the period surrounding the global financial crisis. Academic research has documented a related structural shift. For decades, United States Treasuries commanded a convenience yield, a premium investors paid in the form of lower returns simply because the securities were regarded as uniquely safe and liquid. But that special status has eroded as the sheer volume of issuance has reduced scarcity. When supply expands relentlessly, the scarcity premium shrinks and can even turn negative. The result is that the United States can no longer borrow at the same preferential rates it once enjoyed relative to other sovereigns. In this environment, any additional selling pressure from a major foreign holder becomes especially consequential. To mitigate the risk of outright Treasury sales, officials encourage the expansion of a Federal Reserve facility that allows foreign monetary authorities to obtain dollars against Treasury collateral without selling the securities in the open market. The arrangement provides temporary liquidity while avoiding the price discovery that would accompany large secondary market transactions. In effect, it allows Japan to acquire the dollars needed for currency support while the bonds remain parked as collateral rather than appearing as outright sales that could elevate yields further. The joint intervention itself produced an immediate reaction. Coordinated purchases totaling tens of billions of dollars strengthened the Japanese currency by roughly 5% over a short period, moving the exchange rate away from its multi-decade extreme. Yet within 2 weeks, a substantial portion of those gains had reversed. Foreign exchange markets turn over trillions of dollars daily. Even a sizable official operation registers as a modest fraction of overall volume. Once the immediate pressure of official buying subsided, the underlying interest rate differential reasserted itself and the currency resumed its earlier trajectory. Broader policy contradictions compound the difficulty. Efforts to strengthen the Japanese currency collide with trade measures that raise the cost of Japanese exports and with investment commitments that require Japanese capital to flow outward, both of which tend to weaken the yen. Simultaneously, American authorities seek lower domestic borrowing costs while maintaining large fiscal deficits and a desire for a competitive exchange rate. These objectives cannot all be satisfied at once. The bond market ultimately arbitrates the inconsistencies by demanding higher yields. Japan faces its own constraints. Raising domestic interest rates would strengthen the currency at the source and reduce the need for intervention, yet political resistance to higher borrowing costs remains strong in an economy already carrying debt well above 200% of output. Debt service costs already absorb a substantial share of government revenue. Historical episodes of aggressive monetary experimentation in Japan have left a cautious institutional memory that further tempers the pace of policy adjustment. For gold and silver markets, the implications are direct and multifaceted. Rising long-term United States yields increase the opportunity cost of holding non-yielding assets, yet they also signal fiscal stress and potential erosion of confidence in the long-term value of fiat claims. When major foreign holders face pressure to liquidate treasuries, or when official interventions merely postpone rather than resolve underlying imbalances, investors often turn to monetary metals as independent stores of value. Currency volatility itself tends to elevate demand for gold, particularly when the dollar's special status shows signs of gradual decline. Silver, with its dual monetary and industrial character, responds both to these financial currents and to the broader growth outlook that higher rates may constrain. The carry trade complex links Japanese funding conditions to risk appetite across asset classes. Any sustained unwinding would tighten global liquidity, raise volatility, and typically support safe haven flows into gold. At the same time, higher American funding costs feed into mortgage rates and consumer spending, influencing industrial demand for silver while reinforcing the monetary premium attached to both metals. Market participants monitoring the dollar-yen exchange rate, therefore, watch not only the immediate price action but also the secondary effects on Treasury yields and the broader term structure that shapes real rates, a critical determinant of precious metals performance. Official statements continue to emphasize partnership and mutual support. Independent analysis, however, highlights the structural interdependence. The United States requires continued foreign demand for its debt, while Japan requires a more stable currency. Neither objective can be secured indefinitely through intervention alone. The underlying interest rate gap must eventually narrow either through Japanese rate increases, American rate declines, or some combination of both. Until that adjustment occurs, episodic interventions may produce temporary calm, yet the fundamental pressures remain. Recent auction results underscore the market's evolving assessment of American credit. Clearing yields on long-dated securities at levels last seen a generation ago indicate that investors are demanding greater compensation for duration risk and fiscal uncertainty. The disappearance of the traditional convenience yield removes a cushion that once allowed the United States to finance large deficits at relatively modest cost. In this environment, every major foreign holder's portfolio decisions carry amplified weight, and every attempt to manage exchange rates without addressing interest differentials risks merely postponing the necessary adjustment. Precious metals investors have long understood that sustained fiscal imbalances and currency instability create fertile conditions for gold and silver. The current episode illustrates the point with unusual clarity. An official operation intended to stabilize one major currency pair has revealed the tight linkages among exchange rates, sovereign funding costs, and the residual demand for assets that stand outside the conventional monetary system. As long as the interest differential persists and the volume of outstanding government securities continues to expand, the pressures that prompted the recent intervention are likely to reappear. Market participants who track gold and silver therefore have every reason to monitor developments in the Japanese currency, American auction results, and the evolving term structure of yields with heightened attention. The scale of global yen-funded positions means that even modest shifts in Japanese policy or in the relative attractiveness of dollar assets can trigger outsized moves. Historical episodes of carry trade unwind have produced sharp appreciations in the funding currency, simultaneous declines in risk assets, and corresponding strength in monetary metals. While each cycle differs in detail, the common thread is the sudden recognition that positions once regarded as low risk contain concentrated exposure to a single funding source. The recent intervention may have delayed such a recognition, yet it has not eliminated the underlying vulnerability. Meanwhile, the preference for short-term government funding leaves the debt management strategy exposed to rollover risk. Should yields remain elevated or rise further, the cost of refinancing maturing bills will climb, increasing the overall interest expense and potentially crowding out other fiscal priorities. That dynamic feeds back into investor assessments of long-term fiscal sustainability and by extension into the relative appeal of gold as an alternative reserve asset. Silver, sensitive to both industrial cycles and monetary conditions, occupies an intermediate position that can amplify moves into either direction depending on the balance of growth and inflation signals. The episode also highlights the practical limits of official intervention in deep, liquid markets. Even coordinated purchases measured in tens of billions of dollars proved insufficient to reverse a multi-year trend driven by fundamental interest differentials. Once the official buying subsided, private market forces reasserted control. This pattern has repeated across decades of foreign exchange management. Intervention can influence short-term price action and buy time for policy adjustment, yet it rarely alters the underlying trajectory without accompanying changes in monetary or fiscal settings. For those who allocate capital to physical gold and silver, the practical takeaway is straightforward. Rising sovereign funding costs, currency instability among major economies, and the gradual erosion of the special status once accorded to United States government securities all reinforce the case for maintaining exposure to monetary metals. The precise timing of price moves remains uncertain, yet the structural backdrop has grown more supportive. Investors who ignore the connections among yen dynamics, Treasury yields, and precious metals valuations do so at the risk of overlooking one of the more consequential undercurrents in contemporary markets. Looking ahead, the path of Japanese monetary policy will remain pivotal. Any sustained move toward higher domestic rates would strengthen the currency organically, reduce the need for external support, and ease the pressure on Japanese holdings of foreign bonds. Conversely, Continued reluctance to raise rates would leave the currency vulnerable to renewed depreciation and keep the option of further intervention on the table. American policymakers, for their part, face the dual challenge of managing a large and growing debt stock while navigating inflation that has proven more persistent than earlier forecasts suggested. The interaction of these two policy regimes will continue to shape the interest rate differential that underpins the carry trade and, by extension, the liquidity conditions that influence gold and silver. In the precious metals trading community, the conversation has already begun to incorporate these linkages. Analysts examine not only the usual drivers of inflation expectations and real rates, but also the secondary effects of currency interventions and the potential for abrupt shifts in foreign official demand for treasuries. The recent episode serves as a reminder that apparently technical operations in foreign exchange markets can carry material consequences for the cost of capital across the entire economy and for the relative performance of assets that derive their value from scarcity and monetary credibility rather than from cash flow promises. The market's verdict, expressed through higher clearing yields at recent long bond auctions, suggests that investors are already adjusting their assumptions about the permanence of low funding costs. Whether that adjustment proves temporary or marks the beginning of a more lasting repricing remains an open question. What is clear is that the era of effortless financing on the basis of exceptional reserve currency status is giving way to a more ordinary calculus of supply, demand, and risk premia. In such an environment, the historical role of gold and silver as independent stores of value regains relevance. Every participant in the precious metals market ultimately confronts the same underlying reality. Sovereign debt levels, currency misalignments, and interest rate differentials do not resolve themselves through official statements or short-term market operations. They resolve through adjustments in relative prices, policy settings, and portfolio allocations. The recent intervention in the Japanese currency has illuminated those linkages with unusual clarity. As the consequences continue to unfold, gold and silver stand ready to reflect the evolving balance of confidence and caution that defines the current financial